Hello, and thank you for tuning in to the Home and Finance Show. I'm Janice Bradley, broker-owner of JB Real Estate Consultants, and joining me is my co-host,
Diana Rice-Wilkerson, lender with Fairway Independent Mortgage.
We are your seasoned, trusted advisors, committed to personally navigating you through the home buying and home lending process. The show is designed to provide you with current and relevant information about different aspects of home buying, home selling, and lending, and refinancing, so that you are knowledgeable when making decisions for you and your family. You can also hear us on Saturdays on Radio 1, 1310 AM, 92.7, and 95.1 FM. That said, if you are in the market to buy, build, or refinance, we'd love to represent you. You may contact us at the information below. Now on with the show, Diana Rice-Wilkerson.
Hello, Janice Bradley.
And we have Shelley today.
Yay.
Shelley Gutzman.
Thanks for having me back.
Yes. Hey, ladies, thank you so much for joining me today. We are going to be talking about two hot topics.
Two.
Yes.
Not just one, but two?
Two hot topics.
Okay, and one of which just was announced this morning. So we want to share it with our listening audience, because listening audience, viewing audience, our goal is to give you relevant, hot off the press information. And this is concerning the FHA mortgage, which I do a lot of. And the big pickup today is that HUD is going to reduce the mortgage insurance premium. This is the monthly mortgage insurance premium. So Janice has this saying where she says, talk to me like I'm a 3-year-old. Tell me what you're really telling me.
It's getting to be 2, but I'll settle for 3 today.
And so the situation is with the FHA mortgage, the mortgage insurance is factored into the monthly payment. It is insurance that protects the lender in the event your loan goes into foreclosure. That rate typically, with a minimum down payment of 3.5% of the purchase price, that rate is 0.85%. So I'm gonna just kind of give you some numbers here, nothing you just need to calculate, but 0.85% is what that is. That 0.85 might as well be added to your interest rate. So let's say if your interest rate is 6% and we add 0.85 for mortgage insurance, then you're paying your payment back at a rate of 6.85. So the beautiful thing about this change is that HUD is reducing that down to 0.55. So instead of 0.85 for your mortgage insurance, it's going to be 0.55. And what does that mean? I mean, like, again, I'm ecstatic about it, and we just want to share. We're going to share with you what that means. So I did a scenario for us to review today on the show, and the scenario I used was a $240,000 purchase price. So with taxes and insurance and the rate being mid-6s, the payment would be $2,016.70 with all of that rolled up into it. With this reduction in the mortgage insurance rate, the payment would be $1,959.08. And so I think that's about maybe $57, something in that range. And so you might say $57. Number one, all money saved is good money, so that's a good thing.
That's a good thing.
But what it really does also, it gives you more borrowing power. So what I did was I said, okay, so if my borrower can only qualify for 2016, how does reducing that rate help them if they want to qualify for more? So I had to raise the price from $240 to $250 almost. I mean, real close to $250 for me to get to this same payment of 2016. So now we've just kind of reduced one part of the payment and increased another part of the payment.
The most
important part. You're right, Janice. The absolute most important part. So that's what that reduction does, and that's on the purchase side of the transaction. If you're refinancing, it works the same way. It's just a big deal. I think when we got into the business, Janice, golly, it might have been 0.2 or 0.3.
It was very little.
It was very little, 0.2 or 0.3. And then it got up, even was more than 0.85. It was like 1 point something. And just so you know why, this money that's collected every month goes into a pool, and that pool then is accumulated. And it helps buyers who get behind in their mortgage payments. Sometimes they need a loan to get caught up to get caught up. Sometimes they need a loan to get caught up with their mortgage payment. That money comes out of this pool. And the other thing is, if without the mortgage insurance, I should say, then buyers would probably be looking at higher down payment requirements than 3.5%.
Sure.
But is that not good news?
It is. It really is. When they went up on the PMI, was it been like maybe 5 or 6 years ago?
I want to say.
Yeah, I don't think it's been
maybe.
any longer than that.
Mm-hmm.
And that was interesting. You know, that was interesting. And again, trying to replenish the pool. But I
Yes.
think from some of the information that I read, they really don't need as much.
They don't need as much now. Now, when they went up before, it
Yeah.
was right after the meltdown.
It was.
Everybody
It was.
needed money. So can you imagine a pool of money set aside for hardships, and everybody had one? You know what I'm saying? So the money went down. But yes, to your point, over the years, we've been reading where the pool of money has increased. And so, HUD is getting ready to make it happen. Make it happen,
for us.
and what a perfect time, because rates are higher now. So if you've got rates being higher now, and you can reduce one of those really important factors in that monthly payment, you guys, it's just a big win. It's the bomb diggity.
Well, talk about the PMI for a minute, please,
Okay.
Diana.
That's such a good question.
The good, bad, and the ugly.
You
But
guys,
most of it is really good.
It
I mean,
is
seriously,
very good.
there's
It
no
is
doubt
very
about
good.
it. Other people think it's bad. They don't really understand how it works for them.
Well, yeah, until you need it, right?
Right. So again, talking normal market. Normal market is one where the property values appreciate 3% per year. So let's say you had a $100,000 property values would increase 3% a year. That first year it would be $103,000, and then the second year I think it would be like 103 something, I don't know, 9 something. Anyway, it increased 3% a year. Okay, so when you're putting down very little, like a 3% down payment, which is the down payment requirement on conventional loans now for first-time buyers, or 3.5% FHA, which can be used by anybody, what you have is a situation where you are financing the vast majority of the purchase price of the house. Okay, that's all well and good until there's a foreclosure. So let's just say by just normal market changes, that $100,000 property that you purchased did appreciate to 103. But then let's say the next year it went down. Let's say it's now back to 100. Let's say also, unfortunately, you lost your job in that year, and let's say that house went into foreclosure. The sale of that house 9 times out of 100 is not going to net the bank back the full amount needed to pay the $100,000 that's due.
Right.
And so they're looking for insurance. Basically, mortgage insurance is mortgage insurance. The insurance, which is HUD with FHA, and there's private mortgage insurance companies that do the same thing with conventional. And then, of course, there's VA insurance. It's different names. It's the same thing. They're the ones that come to the rescue and pay the difference for the lender. So that's what it is. You will hear some things that are not true. You will hear that it's better to go for a conventional loan without mortgage insurance. That is that blanket statement in many cases is not true. If you have 20% down on a conventional loan and you're a conventional buyer, that's a great way to eliminate mortgage insurance altogether. There are some mortgage insurance premium programs with conventional financing where you in fact can pay a flat fee and buy out your monthly fee. You have to make sure that makes sense. But the real point is it's that mortgage insurance that's letting you buy a house without a lot of money out of pocket. And it protects the lender who's gonna be afraid. They've always gotta look at the downside. Even you, when you're making an investment, you have to say, what happens if this goes wrong? So if the lender says, hey, what if you've got a substantial down payment, you've got enough equity in there that even if it goes into foreclosure, the house can probably be sold for enough money to pay off the loan. So that's okay. But when you're like most people, and most of us have bought our first homes with using lower down payment programs, then that insurance is what's going to let you get it financed. And that's your wealth building machine. That's your first step. And you definitely want to become a homeowner. So this will allow you to do it. It is something that does not necessarily have to stay on the loan forever. This is something you want to talk to your lender about.
Yeah.
One of my questions, I did not know this, that you can have a flat fee to buy out PMI.
That's unconventional, isn't it?
Unconventional,
That's only
yes,
unconventional
yes,
deals. Okay.
yes, but you can have a flat fee. These are basically new programs, I would say, in the market. I want to say maybe if they've been out longer, I would say their popularity has gained in the last maybe 8 to 10 years.
Is that based on the loan amount? Is that like a $5,000 fee, or is that something that's more? It's easier to pay just an extra $85 a month versus having to pay a buyout fee of $5,000 or $10,000.
So that is a step that we do go through when we're looking at those options. We're looking at that step of saying, hey, if we go with the one-time buyout, how much is that? Versus the monthly fee, how much is that? So mortgage insurance, that program, conventional mortgage insurance, is pretty much tied to the type of mortgage insurance you have, the coverage, okay? And your credit score plays a big role. So in fact, your mortgage insurance premium, like if it's a borrower, like I'm working on a loan right now, borrower's credit score is 780. I quoted her with mortgage insurance, monthly mortgage insurance. Price of the house is like close to $3,000. Her payment's only $48 a month on her mortgage insurance.
Okay.
So, she could potentially buy it out.
Yes.
It may cost her just a couple of $1,000s, or she could leave it in, $48 a month. Right.
Yeah.
So there's some steps. I mean, every time we bring something to you in terms of a program that involves a dollar amount or a fee, then we have to reevaluate all of it. But yes, it is so no longer do you have to necessarily put down 20% to avoid mortgage insurance. Right. No longer.
Yeah, we've had a couple of situations where they bought it out before in order to keep their payment. But let's speaking about the what you were sharing about the somebody was in trouble and needed help, and it's called the partial claim. And I found that to be a great just something that the people could fall back on, had no idea.
Yeah.
And has really helped them keep their house. And
right.
One of the things is that it does have to be paid back, but of course it helped you, and we need that to help somebody else.
Right.
Now,
right.
my question to you, again, do a lot of FHA loans just like you do. So does that happen with the conventional or insured conventional if they run into an issue? I've not seen that happen. If they run into an issue that they have something they can fall back on. I didn't think so.
No.
Yeah.
So your government products, just in general, you're going to find those the safety nets built into your government products. Your government products are designed with just the average person in mind, meaning that this person may have a good score, may have an outstanding score, but doesn't necessarily need that necessarily. They're forgiving of financial crises situations. They're forgiving of medical debts and things of that nature, not holding them against you. If you buy a lemon, like, some people have bought a vehicle, didn't know it, but it was a lemon, and so they had to return it. So they're forgiving of charged off accounts and things of this nature. They have mandated by the government in their servicing paperwork, and I heard this many years ago, and I can't imagine that it's changed now, but what's mandated to the servicers, these are the people that collect your monthly payments. It's mandated that if a person falls behind, gets into trouble, they may have 4 or 5 workout situations, one of which is the partial claim.
Okay.
Because the other thing they can do is, if you're back on your feet now, they could work out a modified payment, right?
Okay.
That lets you pay a little extra each month that gets you back on your feet. If you've had a real severe, just a medical situation would come to mind for me, where you just have lost a whole year's income, right? They may rewrite that balance on your loan for a 40-year term at like a 2 or 3% rate, just to give you an example. But these are mandated, which is one of the reasons I love the government programs, because it's not left up to the servicer feeling about it, right?
Discretionary.
They're yes. So conventional loans, guys, are generally, well, first of all, confusing. Conventional loans are any loans that are not a government loan. And then once you splinter off into that, any loan not a government loan, you've got multiple different type of conventional loans in the marketplace. Some banks have their own personal loan. It's called a portfolio program. They designed it themselves to meet their needs. It's a conventional loan only because it's not an FHA or VA loan. There are 2 major investors when it comes to conventional loans. That's Fannie Mae and Freddie Mac. I think that's an equal opportunity, Fannie and Freddie. But those programs they don't come with government bailouts, right? They're not government programs. They're kind of quasi, to some extent, controlled by the government, but they are not government programs. So again, when people say, hey, I was told not to get an FHA loan, and I'm looking at my borrower and I can see my borrower is everybody's ordinary person.
Yes.
They may have had some challenges in the past, the whole entire bit. It's your choice what product you want to get approved for, if you can get approved. But I always let them know, listen, if you run into a situation, the government's going to try and help you keep you in your house.
Right.
They're not interested in getting you put out. Yeah.
Right. And if 2020 taught us anything, is insurance is fantastic,
Yes,
right?
yes,
Having a
yes.
backup plan, and that is a great resource
Yes,
for
very
a lot
good
of
resource.
homeowners.
Very good resource. So today, what I would like to talk about, and we have a few minutes to chat. This was the planned topic, folks, but this other about the reduction in this mortgage insurance. Let me
Right.
back up. It is supposed to start with loans being endorsed by FHA by March 30th, okay. So endorsed means
Wow.
that the lenders close the loan, you're in their house, you may have been in your house for a while, HUD is looking at the property and then endorsing it, okay. Which means to me, there are gonna be some people that are gonna get some refunds, right?
Yes.
There's gonna be
Yeah.
some folks that are
Wow.
gonna get some refunds. It may be a minute, it may be a while, but just want you to know that that's the way they're doing it. Instead of with new loans starting, March 1st, they're saying loans that will be endorsed. So they're on the back end. So you will be getting some refunds out there.
Okay.
The other thing I want to talk about today is refinancing. And refinancing is just something that a lot of people, I think, need to really be exploring. Now, I'm not telling you what to do. We never do. But giving you information to make a decision, we always want to, okay? So basically what's important, I feel, to owners of property, first of all, to refinance, you need to own the real estate. So essentially a refinance is nothing more than a restructuring of the loan that you have on the property. If your property happens to be free and clear, you're creating a loan, okay, against your property for you to take certain action. But in most cases, when we're talking to borrowers who are looking to refinance, they owe something on the property. And the rates are higher today, but still, there are reasons that you may want to consider refinancing that really are going to put you in a better position, even if you have a lower mortgage rate. So what comes to mind? One of the things that comes to mind, and let me back up. How are people getting in this position to refinance? Well, what you're doing is you're tapping into your home equity wealth bucket. So we talk about homeownership is critically important. It's the best way to start building wealth, et cetera, et cetera. These are factual statements. But looking at the home itself, how you're building that wealth is you bought the home, it cost a certain amount, you had a certain amount for down payment, you're making payments each month. So as you're making payments each month, your principal balance owed on the property is being reduced each month. And that is creating wealth from making payments. So you can put that little dollar amount in your bucket. Then while that's going on, just by virtue of the fact that you own real estate and people are continuing to buy houses and the values of houses are going up, so is your value of your home. So you might have spent $200,000 a couple of years ago. Many cases today, if they're selling, and I've had a lot of people take advantage of this great space we're in, those homes are almost appraising for $300,000 or better. So within even if it's 50, in 2 short years through appreciation from just owning real estate, this person has gained $50,000 in their wealth bucket,
Easy.
potentially.
Yeah.
It's been amazing, guys. That's why we encourage you, if you're renting, to look into ownership. So let's say you are a person who's owned your home for a while, and let's say you were in on that 3-point-something interest rate, and now you've accumulated quite a bit of equity, and you can always call me or Janice to talk about this. And you might say, okay, so how does this equity, first of all, how do I get to it? There's a commercial where the guy has actually got a big old something, a sledgehammer, and he's saying, give me that equity, give me that equity. So it's always going to be borrowing unless you're selling your house and then you're going to walk away with it in your hand, a check, okay? But in most cases, and what I'm talking to you today about, is you're going to be creating another loan. So that's how you tap into your equity. You're going to create another loan. You might say, Diana, why would I ever do that? Rates are in their 6s and 7s. My mortgage rate is 3.5. Okay, so this is why you might want to consider doing it. Let's say you owe currently, I'm just going to say $150,000 on your house. Let's say your house is worth, let's say $250,000. So you got $100,000 worth of equity. You might decide you want to use some of that equity to make home improvements. So you can borrow money on a loan. We would rewrite the whole loan and give you money to make home improvements. You might also say, hey, I've got credit card debt that I want to get out of. And my credit card interest rates could be anywhere, 9, 10, 15, 20, 21. A lot of you fall into this bucket, okay? And so you could actually borrow the money in your home, borrow your equity to pay off your credit cards. How is this going to impact you? Yes, your interest rate is going to be higher on the loan than maybe what you have right now. But you now have just consolidated all of your debt into one space, and you may have a 6.75 interest rate or a 7, but you no longer are paying interest out at 18, 19, 20, 21 with those credit cards. Okay? That is a restructuring of your debt with your assets. Typically is going to make your mortgage payment, if you take your current mortgage payment and you add your current debts you're paying out, guys, people even include their cars. I mean, you add all of that up, what you're currently paying out, you got to look at it. You could potentially pay off all of that. And now your mortgage payment may have only increased $300 or $400.
And be done with it.
And be done with it.
Yeah.
And if you say, well, now it's going to take me 30 years to pay off this debt that I could have paid off. No, not necessarily. We write the loan for 30. If you want 20, if you want 25, we'll do that as well. I would say your best practice is to extend that payment out for as long as you can and pay extra towards your principal. So let's say you owe $15,000 on a credit card, and let's say you roll that into a mortgage. In theory, what that's going to bump your mortgage up to, and $15,000, you're probably paying $300 a month, or you're not paying anything toward principal and everything's going toward interest and you're not making headway. But if you roll that into a mortgage loan, your payment might go up to $100 to cover that $15,000. And so if you're paying 3 separately, and now it's going to go to 100, right?
Right.
Then from a cash flow standpoint, you've improved your situation. And if you want to pay that additional $200 a month on the principal, then you can do that. So you do not have to keep your debt open for 30 years. All of those are myths, guys. And like what I would encourage you to do is call me so we can talk it through. If it does not make sense, if you cannot get comfortable with it, absolutely don't do it. But you can tap into your equity to do home improvements, to pay off debt. This is credit cards, loans, and vehicles. You can pay cash for a vehicle. I had a lot of people do this.
Do that when
refinancing
was
just
hot.
pay cash for your vehicle. You're borrowing the money through your mortgage, but you've got an extended term and a lower rate, much lower than what you're going to get on a vehicle loan. So there's just a number of things to do. You may have medical debts that you want to pay. There's just a number of things you can do. And so we want you to understand that if you are experiencing any type of cash flow challenge, you're tight in the least bit, and you own your own property, you want to talk to somebody about, is refinancing a good option? We're going to at least give you your loan scenarios and let you think about it. There's no hard sell here. This is just a way that we would prefer to educate you. And this is wealth building, because it's through the wealth building of your home that you are using that to take care of this debt. If you chose not to do anything, okay, I'm just going to sell my house, it's too big anyway, whatever, then you're going to get the money at closing, and at that time you can still pay off the debt.
Right.
You know, just recently on your radio show, you had a caller who called in and said, I know the interest rates have gone up a little bit. Is now still a good time to refinance? And through the course of you asking her a couple of questions, she shared that her current interest rate is 12%.
Yes.
And she was shocked that she could get lower than that, because all she had heard, and on TV or the news was that interest rates are high, interest rates are higher, interest rates are going up. But you were able to significantly change her cash flow.
Exactly.
And her lifestyle,
Exactly.
her options for her.
Exactly, and it is a lifestyle cash flow change. And we talk about buying all the time, but owners, we are here for you as well to let you know how you take this asset and make it work for you. If you happen to be over 62 years old and you've been in your home for a time and you've got significant equity and you still have a mortgage payment, you may be able to refinance that into a reverse mortgage.
Yeah.
This again is a FHA reverse mortgage,
Right.
government insured deal where you don't have a monthly payment period at all. I mean, again, you're living off the equity on that home to take care of yourself financially. So those are a few of the things that, I just wanted to make sure that you are aware of. And, don't be afraid of it. And don't be afraid of it. No one's going to make you do it, but at least seek out the information.
And real quick, Diana, we were talking about a lot of people do not, just like you were sharing, Shelley, about the what their interest rate is, and hers was 12. But I don't think a lot of people realize that on their coupons, that information, that actually has the interest rate.
That's right.
I know we don't have time to for you to kind of share some of the interest rates that you have seen, that you've been able to refinance. I know that, but I just wanted to, put
Yes.
that little.
That's a great point.
Yeah, pull out your statement. And guys, always call me or Janice. I mean, you can always call us. If you're pulling it out and you don't know what
to
you're
go.
looking at, there's no shame in our game. We're in it together. Always call me or Janice for us to go through it with you, and we will certainly do that. But again, for the you homeowners out there sitting on this wealth, I think it could be $2 to $3 trillion. Look and see how can this improve my quality of
Lifestyle.
life, and don't do anything you're not comfortable with. But for most of the time, my clients are very happy to get the information, and then they decide they might fund an emergency fund, make a few home improvements, and also pay off some debt.
And go on a nice vacation.
And thank you so much for joining us today.
Have a great day.
Bye-bye.